1, 2, and 4, okay? So, this is the part, okay, relevant, because, the part I, okay, cover this will help us to, okay, set the stage for chapter 9. So I'm not doing the whole chapter 8. So from the homework, you probably also notice that. All right, so everybody is doing budget? How many of you do budget? A little bit? Yeah. Oh, yeah, okay, I see some hands. Awesome. All right, so this is actually really good news. Okay, budget, okay, everybody needs budget. So it's a plan. So, anybody heard of Dave Ramsey? Yes, awesome. If you haven't heard, he's in the personal finance space. He teaches people how to, okay, manage your debt, okay, do zero-based budget. Okay, so if you're interested, okay, you can check him out. So one thing I actually mentioned this is because, okay, this is a small thing, okay, his team does, okay, some service, among all the millionaires, okay, so this is what they found. The top 5 career for millionaire include engineer, if you can see that, engineer, accountant, teacher, management, and attorney. Okay, doctor didn't make it on the list. Okay, so accountant number 2. So I have a series. Okay, so engineer, I think, okay, because they actually get high pay and they also very busy, so they don't really have time to spend their high pay. So that's why they get to millionaire. Accountant, I think we just know how to budget. We know how to spend our money, how to allocate resources. So we have that kind of, okay, expertise. So that's why we can be millionaire. All right, how many of you plan to do public accounting CPA? Oh, lots of hands, very good. All right, so if you haven't decided, okay, this is actually a pretty good career path. So I just want to show you this picture. So this is the one from KPMG. So they basically show the, okay, career, okay, progression. So so when you make a decision, right? So not only just the starting salary matters. You want to see, okay, 5 years or 10 years, okay, so along the way, where you are gonna be, right? So that's basically the budgeting concept, right? So budgeting concept, you don't look at this month, this week, or this year. You look at, okay, how your plan for this year fits into the bigger plan in the long run. So 3 years down the road, 5 years down the road, okay? So this is, okay, so if you start here, basically 15 years, you're gonna get to partner. So doesn't matter what your starting salary will be, so it will be 7.5x, right? So I think, okay, so other area, okay, other subject in the business school, they are not doing as well as, okay, being a public accountant. You probably do better here, but not necessarily, okay, down the road. Okay, so that's why you have to think about this in a bigger picture. So hopefully, okay, this will help. All right, so if you haven't done budget, okay, so budgeting is the easiest subject in my mind, okay, to study. It's also most useful because you can start practicing on your own, right? So the easier way is, okay, you start, okay, how much money I have for this month, where is my expense, right? So they just make sure at the end of the month you don't, okay, go bankrupt, or you don't need to borrow money from your friends, right? So then that will be a good budget, right? So so if you are curious how to do this, so this is an article, I'm sure you can search for most recent article. They always, okay, have articles about how to budget. So they give you, okay, how you do this, right? So usually there will be 3 buckets, right? So you will, how much, okay, what percentage you're gonna spend on living expense, right? So the 4 walls, right? So the clothing, the transportation, and everything, your cover your tuition and everything, cover your, okay, now the book and the supplies and everything. And then how much you wanna do, okay, for entertainment, right? So how much you wanna save, right? So there will be all different kind of invest. So you can, okay, so it doesn't matter how you budget, it's most important you start budgeting, okay? So start budgeting is the most important thing. So So today I just advocate stop budgeting. Okay, so you never, okay, first of all, it's gonna, okay, help with your own life. Secondly, it will improve your understanding about this, okay, all these things. And which, okay, later on, if you really, okay, take a job in the private sector, you might get into the, okay, so into the scenario, you have to help the manager to budget. If you do not understand the concept of budget, that will be a problem, all right? So why do I say that? So this is during pandemic. So when the company are struggling with revenues and everything, right? So they go back to budget, right? So if you can't work too much on the revenue side, then of course you're gonna work on the cost side. So this is 2020. So this is basically the company will turn to zero-based budgeting is basically just how much money you have. I'm gonna make sure every single dollar will be spent on certain things. So I wanna make sure I don't have any extra cash laying around and just for uncertain. No, just we know exactly how we spend every single resource. So that's the zero-based budget. Okay, and then so 2 years later, so this is 2022. So again, zero-based budgeting. So it's always the company when they are not doing well in their financially, then they're gonna turn to budget. Okay, so that's why it's important. Now let's look at the concepts. Okay, so how many of you have seen budgeting in your introduction class? 1, 2, okay, a few, okay. So what did you do? Cash budget? Did you do cash budget? Yes. Did you do a sales budget? Yes. Production budget? Yes. Capital budget? Okay, so you pretty much cover everything, right? That's good. So then, then this will be a review. So correctly, I put at review. Some of you have you don't remember, you forgot about this, or you haven't learned this. So then this will be something you can quickly pick up. Okay, so I'm treating this as both review and as if you don't have to. I'm not skipping any concept. Okay, but also putting everything here together with what we have talked about for the first part of the semester. You will see how all this information will put together. Okay, all right. So when we talk about budget, basically setting the goal at the beginning of the year, January 1st. That's what we are talking about, budgeting. Okay. Now, if you only have planning, so that's what we call planning. If you only have planning, that's basically New Year resolution, right? So you have to have control. If you do not have control, what do we mean by control? That means you have to see how well you did, when you have a plan and when you have a goal, how well you actually implement that goal. And by the end of the year, by the end of certain period. So, and then you are gonna give feedback. And then you're gonna say, do I have to change? Where do I have to change? What kind of corrective action I have to take? So that will be control. If you do not have control, then that's not budgeting. That's New Year resolution. Okay. So and then after exam 2, when we come back, so this is chapter 9. We are gonna start chapter 9. It's all about this. Okay. So when we get to variance analysis, it's all about the control. So control is super important to make sure you have the budget. Okay. All right. Now, so this is the picture. I wanna give you the sense about where the budget fits into the grand picture of the planning for the company. So the company usually, the manager will have a strategic plan. The plan will will becomes the long-term objective, right? So long-term plan, right? So if you think about for yourself or for your family, right? So 3 years, 10 years down the road, what's the goal, right? So we want everybody happy. We want everybody live a really the life they want, right? So that's the strategic plan. Then you want to come down to so you want to so where do you want to do you want to buy a house, or where do you want to locate? And then so you want to have a long term, 10 years down the road. And then you're gonna have the short term, right? So 3 years or 4 years, and even the in the current year, what do I do, right? So I'm gonna finish the degree and find a job and where, or maybe go to the grad study, or maybe try to get CPA. CPA, okay, certificate. And then, okay, once you have that, and then you are gonna come down to, okay, the budget, okay, exactly what you do this year, how much resource you have, where you're gonna spend your resource, what kind of goal you wanna do, okay, I wanna make sure I get everything, okay, all the courses, okay, to A for this semester, right? And then with all the resources I'm using, okay, do I need to get extra money or do I have enough, okay, do I have to plan for the next year? So then you're gonna have all this. Then once you determine this, okay, at the end of the year, you're gonna, okay, or at the end of the semester, you're gonna, okay, evaluate how well you did, okay? So then that will be feedback and that will be control, okay? So this is basically, okay, the idea of budgeting for okay, for yourself, for your family, for a company, for university, for government, okay? So everybody should do, okay, similar thing. Now for the company, in the company setting, so this is what we have. All right, so I want you to, okay, recognize the keywords here. So top level managers, so they will, okay, engage in 5 to 10 years strategic plan, which basically set up the goal, long-term goal. And then the management team, basically the middle level and top managers, they will identify the key variable. Okay, so they will say, do I wanna, okay, so boost the revenue by expanding the production line? Or do I wanna do, okay, so do I wanna, okay, change the direction? Do I wanna get into new market? So all that thing, right? So you're gonna analyze, okay, the key variable. And then devise the short-term plan. So budget is the one of the, okay, short-term plan you can do. The budget actually serves as a guide, right? So that's basically communication tool. So this is, okay, once you get a budget, you send it out to the, okay, company, and then as a way to communicate to everybody in the organization, say, this is the resource we have, this is the, okay, the place where we're gonna spend resource. Same thing with the university, right? So I'm in the faculty senate. So so right now is the, okay, budgeting season. So the the president and the provost, they will just, okay, so they will say, well, so here is, okay, we need to focus on, right? So we need to focus on student life, we need to focus on the course content, and then here is the resource we have, and this is the scholarship we need to set up, right? So there will be all different kind of plans, and then so that's how you communicate. And then we will, okay, require, okay, everybody can give feedback, right? So the employee will, okay, participate, say, okay, this is, okay, really in need, okay, we really need a resource to improve this area, otherwise we, okay, so the whole plan will fall apart, right? So you need, okay, feedback from the comments or suggestion from the employee. So once you get this, the budget committee will review and approve. So once the budget is approved, that become a plan. You have to just implement, right? Because budget has to be a detailed plan. What do you actually do? It's not some kind of blueprint. You just say, okay, we plan to do this. You have to know exactly what you need to do. So down to some actionable item. So that's what budget is about. So once you implement the plan, that will get to the control side, right? So at the end of the year, you're gonna say, okay, are we, okay, too aggressive, too optimistic, or are we okay? Are we setting the goal too high or too low? And then can we, okay, what kind of things we can improve so that next year we can do better? Okay, so that will be chapter 9. Okay. All right, so that is the whole budgeting process. So hopefully you get some idea, right? So what to do? Then we'll come back and focus on this, right? So the budget becomes so important, right? So then you go back to say, are we deviating from the long-term goal, right? So that's what we don't want, right? So you don't want to say, okay, this year, whatever I'm doing have nothing to do with 3-year plan or 5-year plan for my family. So that's not good, right? So if you already have a long-term plan for your family, you want to every time you make a small short-term plan, you want to make sure that help the long-term plan. So that's basically the idea of control. All right, so the overall the budget is called master budget. Okay, so it's a comprehensive plan. So in general, we will have 2 sides. Okay, one side is on the operating. We decide exactly, okay, how many units we're gonna produce, where do we get the material, labor, overhead, and then how many, okay, so what are the expenses we have to incur, And then at the end of the day, you're gonna, okay, estimate, basically prepare an income statement, okay? Financial budget is on the, okay, resource side. Where do you get the money, right? So the cash budget, right? So where do you get the money? How you spend money? Where you have to use cash? Do you invest cash, okay, for short run and or not, right? So if you have cash, okay, so it's like Apple, right? So they have a big pile of cash, right? So what do, right? So they have, okay, even after they invest all the possible projects they can, but they still have some extra cash. What do, right? So that the cash management is important. So then, okay, do we borrow money? If we do borrow money, do we have to pay interest? How are we gonna, okay, pay the debt? So all this will be, so notice those items, the asset, the cash, the liability, the debt, those are the balance sheet items. So that's okay, at the end of the day, you're gonna get a pro forma balance sheet. For us, okay, so we are gonna focus on this. So the operating budget, then, okay, our goal is try to prepare an income statement. I'm just gonna show you how we do this, right? So once you get an idea, right? So if you haven't seen this, you get an idea how to do this, and then you're gonna, so then, okay, the rest you can just, okay, work on your own and then figure this out. So knowing how to do budget is very, very important. And then there are all different kinds of budget you can do different ways to budget, right? So you have a static budget, or you have flexible budget, and you also have, okay, ABC related budget, okay? So that's all these things, okay, how you actually manage in your costing can be tied into the budgeting process, okay? All right, so now, okay, so this is the picture from the textbook, all right? So I just wanna give you the idea, okay, where we are. So this is basically, okay, for all the whole budgeting, this is what we focus on, okay? So this is, okay, so this is all we focus on. I'm gonna, okay, go through 6 problems, all right? So show you step by step how to do the budget. And then, okay, so then the step was just in the order of how you estimate, right? So first step, we're gonna do sales budget. We recognize the sales revenue, how many units we have to sell. And then we are gonna determine how many units we're gonna produce. And then we are gonna, okay, based on how many units we're gonna produce, then we will estimate, okay, the direct material, direct labor, and overhead. Okay, so that's the same kind of thing as what we did, okay, for the first part of the semester. And then after that, and then you're gonna, okay, estimate expense and the COGS. That's question 6. And then once you have COGS and the expense and revenue, then we have our budgeting income statement. So that's as far as we are gonna go. So that's 1, 2, 3, 4, 5, 6. 6 problems, okay? So if you kind of, okay, where are we? You can go back to this. So that's the order we are gonna take, okay? So go back to this picture to see. All right, so I'm gonna, okay, go through all the 6 problems in that order. Then the things I want you to pay attention to is basically try to figure out, because you have to imagine yourself, okay, you are not having the table or the information feeding to you, right? So you have to be able to know exactly what information you need. So then, okay, some information will be forecast or estimation. Some information will be decision, okay? So you have to, okay, figure out, okay, so some are the managerial decision, some will be the, okay, the estimation, and then, okay, so what information do I need in order to do the calculation, and what kind of forecast do I have to make, okay? And then T-chart will help, okay? Why do I say this? So this is, okay, what I wanna, okay, so show you, okay? So our goal is to make this income statement, okay? I'm gonna make it small because I need, okay, the space. All right, so my income statement looks like sales minus COGS, correct? And then minus operating expense, correct? And then we get operating income. And then of course you have to take some tax class, right? So especially corporate tax, and then figure out, okay, the tax issue and so on. So then there will be, okay, tax and then all the other things. Then you will get the net income, right? So, but we are gonna go as far as this, right? So this is all we are gonna go. We'll worry about sales, COGS, operating expense. Now, COGS, okay, so where that come from? Isn't that coming from the credit side of finished good, correct? And then you're gonna have, okay, so beginning balance, ending balance, and the debit side is COGM. Remember that? So that's from job order costing. That's the cost of goods manufactured, correct? And then, okay, where do we get that? So this is basically, okay, so you get this, right? Now, okay, so then that will be from working process, right? So working process, you also have beginning, you have ending, right? So COGM is on the credit side, correct? And then, okay, we also have direct material, direct labor, and overhead, correct? Right? So that's basically, okay, where you are. And then, of course, direct material is coming from material account. So you will notice I'm gonna show you table after table, but all the tables are actually based on those T-chart, okay? So that's why, okay, if you know the T-chart, you know one T-chart, because all the structure is exactly the same. It's not that hard, then you don't feel like you have to memorize the formula or the format, right? So you don't have to do that. All you have to do is, well, so I understand where they are, what information I'm looking for. So this is basically, well, so I'm gonna estimate, right? So first of all, estimate the sales. Then I'm gonna estimate how many units I'm gonna produce. And then I'm gonna get into material, labor, overhead. And then after we do this, the rest of that you just have to compute, right? So because here I'm gonna get COGM, cost of goods manufactured. So cost of goods manufactured will go into finished goods. And then the finished goods will help me to, from the finished goods, okay, T-chart will help me to figure out the COGS. But if you do not have used the T-chart, you're gonna see, okay, everything is okay by itself. It becomes super confusing, right? So you wouldn't know why I'm using this number and not the other number. And then this picture will show you that, okay? All right. So I'm a big advocate for T-chart, as you say, right? So then, okay, so hopefully that will be helpful. All right, so let's any question? Okay? All right, so let's okay start with the sales budget. Okay, sales budget is always the first thing you do, right? So you have to estimate how many units you're gonna sell. And then, okay, so this is basically, you're gonna, okay, estimate both units and sales revenue, which is the dollar, okay? So we need both information. We need the unit information because you can't just base on dollar amount to produce, right? So you have to base on the units. So that's why, okay, we will estimate both. It has to be accurate. Try to be as accurate as possible, because if it's not accurate, then the rest of that is all like, okay, it's useless number, right? Usually the marketing department, so luckily this is not our job. Marketing department manager, they will decide, right? How do they make the forecast? They will have a couple of things, right? So it depends on the economy, depends on the market, depends on how the customer base, and depends on whether they want to open new markets or not, and then also depends on the capability, the capacity of their production, right? So their technology, right? So if you are not updating your technology, then your competitive ability advantage will be weakened. Then of course the company cannot, okay, so you wouldn't expect a large sale. So there will be a lot of things the marketing department manager have to look at, right? But that's not our job. All we are getting is, we want the unit, we want the selling price. If you tell us those two numbers, we are all set. So units and selling price per unit, okay? So then the sales budget is basically units multiplied by, okay, price per unit. So that's not, okay, this is not, okay, I don't want you to think that this is a formula, right? So this is always, okay, dollar per unit multiplied by the unit. That will give you either revenue or cost. Okay, all right, so let's look at first problem. So first problem, we are doing this, okay, for every quarter for the next year, And then, okay, so if you add up the, okay, quarterly number, that will give you the year number, okay? All right, so we have those two information ready for us. So those are the estimation, okay? So those are estimation we got, okay, the marketing manager have to make. All right, so we have sales, 2,000, 6,000, so notice this is a seasonal, right? So the manager, the company is able to sell a lot during the summer and fall, okay, during winter and spring, so the sales come down, right? So that's the, okay, so which probably, okay, is usual for this company. And we also have the selling price. This is based on the demand and supply on the market, right? So we have 1.7, 1.8. All right, so let's construct a sales budget, all right? So that basically means, let's say, well, so what's the total revenue, right? So we are gonna generate. All right, so this is the table you're looking at, right? So we have the units, we have the selling price per unit. All you have to do just multiply together, correct? That will give you sales. So that's not too hard, right? So let me write down 1, so then you can do the rest, right? So that will give you this number, and then you do the same, right? So for all the quarter. For the entire year, every quarter the sales unit, you add them up, that will be the total year. Okay, so that's why you do the sum. Okay, so everybody get that? So when I write the sum, that basically the sum of the entire row. Okay, so that will be the sum of those entire row. Okay, all right. So then we will have, okay, so then the same thing, right? So if you have sales revenue for quarter 1, that will be for quarter 2, for quarter 3, for quarter 2. Add them all together, that will be the total sales revenue. All right, so that's the, okay, sum as well. Okay, sum of the row. Okay, don't get confused. Not the column, is the row. Now, so selling price. This is not a sum. Okay, because, okay, so selling price here should be the total sales revenue over the total units. Okay, so once you get those two sums, right, so you use the sales divided by the unit, you get this number. Some of you probably say, well, why can't I just, okay, add the 4 add the 4 number divided by 4, get the average? You can't do that because it should be the weighted average, because the units are not the same. Does that make sense? Right? So if you have exactly the same units, if I have 2,000, 2,000 all the way, then you do the, okay, so then you can do that. You can add in the 4 unit price divided by 4, then you get the average. But for this case, well, so it go up and down, you can't do that. You can check, okay, so you can check, you can try to do that, do the average of the selling price. It wouldn't be the same as, okay, the answer. Okay, so this is the answer. Okay, so 1.7467. Okay, we okay? So the sales revenue, so the important information is this number, because this number will go into income statement. Okay, so total, so I'm gonna write this, 26,200. So total sales revenue, okay, for the year. All right, so I'm gonna use this information, 26,200. Okay, because later on when I do income statement, that's the first number I'm gonna put there. We okay? So that's the, okay, so everything else. So if you do not know which number you are supposed to do, okay, just raise your hand. Okay, so because I wanna make sure I'm not writing down everything, I already give you the, but I want to make sure you know how to do it. Okay? All right. Good. Question? All right, so the second part, it says, well, as cost accountant, how would you account for the possible economic downturn? Okay, so if there's, okay, if the economy is going up and down, it's very unstable, the best way to do that is a flexible budget. Flexible budget means I'm not setting up a fixed number. I'm not saying 2,000, 6,000 for quarter. I'm saying, well, so here is the possible, okay, so sales price per unit and cost price per unit. I'm gonna, okay, so then I'm flexible, and then I can use my flexible budget to figure out what will be the, okay, what will be the total cost, what will be the total revenue. The number can change randomly. All right, so alternatively, if you know for sure, so either this situation or the other situation, you don't have a whole lot, okay, to change. So if that's the case, this will be one possible, okay, good answer. So you will prepare a contingency, okay, budget. Okay, so the second budget, you can see, suppose there is a downturn and then here is, okay, the revenue we can expect, right? So you can give a range, right? So here's the lowest number, here is the highest number, and then our, okay, sales revenue is between this range. So you can do that, okay? All right, now, okay, so once you have the sales, then we have, okay, we're gonna have, okay, the production budget, basically, right? So we're gonna, okay, going through this, and then eventually we're gonna, okay, budget the income statement. So that's called the, okay, operating budget. So then the first thing we're gonna do is, once you know how many units you're gonna sell, you're gonna determine how many units you're gonna produce. Some of you will say, well, can we just do, okay, if this 2,000 units is what we're gonna sell, can we just produce 2,000? The reason is, it's not gonna work for the real world. That's because, okay, so what if there's some answer? This is, okay, estimation of planning anyway, right? So you want to have a certain amount of, so first of all, the company will keep some inventory. So they will already have some finished goods in their warehouse, right? And then secondly, they do not want to make sure they have 0 units in their ending inventory. Because what if some, okay, customer just, okay, knock on the door and want to order some, right? So you basically let some random customer go. So that's not a good strategy. So usually the manager will have an inventory requirement, an inventory policy. So to determine how many units you want to produce, so this is a purely units to produce, all right? So it's nothing about dollar, okay? So I think I have an extra D there. All right, so it's nothing about dollar, it's just basically how many units we try to produce by satisfy 2 conditions. One is how many units we want to sell, that's from problem 1, and then what's the requirement on inventory, okay? All right, so the way to do this, that's okay, so looking at the finished goods units, right? I'm gonna write it over there. So make it, okay, some space, all right? So for units, right? So then I will just have beginning units. So using the T-chart, okay? I have the ending units, right? So then I will have units sold, right? So then I will have units produced. Are we okay? So this is okay, so beginning units, this is units produced, this is units sold, then ending units, right? So how do we, okay, so by looking at this, and then the comment, okay, so just go over the structure of the T-chart, beginning units plus units purchased. So that's the debit side, right? That equals units sold, all right? And plus ending units. We okay? So this is okay, always true, right? So the debit side equals the credit side plus the ending. That's always true for all the T-chart. Now, to connect with chapter 6, okay? Is a chapter 6 process, yeah, process costing. So this side is called the units to account for, okay? And this side is called the units accounted for. So in case, okay, you kind of forgot about, okay, process costing, right? So that's basically, remember we always keep the units to account for equals units accounted for. That's basically from the T-chart. Now, okay, so because we wanna know units purchased, right? So we wanna know this number, right? So from here, you get units sold plus ending and minus the beginning, right? So you minus the beginning on both sides, then you get this. My point is, okay, this is not a formula. This is purely from T-chart. Instead of trying to focus on memorizing the formula, you might just draw a T-chart that will help you, okay? All right, so that is, okay, so where, okay, we are gonna make some. And this is also, okay, if you wanna know, okay, units to produce, you know how to set up your worksheet. All right, so Suppose we have, okay, 200 units. So this is 200 units finished goods. So this is, okay, reality. Okay, so I'm gonna say, okay, this is a reality because we just go to the warehouse and literally check. So that's 200 units. And then in addition, so we get units sales, so that's estimation. Okay? And then we also get, okay, expected ending units. That's manager's decision. Okay? So the manager decides how many ending units I'm gonna keep for each, right? So I don't wanna keep a lot because that requires space, that requires management, that probably subject to some damage. So that will be costly to the firm, right? So you don't wanna keep a lot. But you don't wanna keep too few because what if the customer have, okay, extra demand, right? So you don't wanna say, okay, come back in 2 months. So that's not gonna work, right? So you wanna say, okay, here is okay, so if the customer come in and say, I require 800, right? So maybe at the end of quarter one, they say, I want to order 800 units, but you only have 500. Then you can say, well, so here's the 500, come back in, within 1 week, I'm gonna deliver, okay, the rest of the 300. So by doing that, you keep the customer, right? So that's why the inventory management policy is very, very important. Okay? All right, so now we get all this information. Are we okay? So now let's, okay, construct a production budget. Remember, the production budget tells us how many units we're gonna produce. You have to understand what each budget is about, right? So this tells us how many units you're gonna produce. All right, so then, okay, so this is the, okay, the table you have. Okay, we have unit sale, we already have that. So the easy way to do this, all right? So it's using the, okay, so this is the quarter. Okay, so I'm gonna, okay, put some information here. So you're gonna see, okay, the reason is because it's gonna help you to see how the number goes. All right, so I need the, okay, so why don't I just read off? 2,500, okay, for quarter one. 2,000 sale, so that go here, all right? 500 ending, okay? So this is quarter one, I have 500, correct? Now, we also have beginning of the quarter, so which means it's the finished goods last year, right? So I'm gonna write, okay, December 31st, all right? So the ending is 200, is right here. Now, the 200 on December 31st will be the balance for January 1st, all right? So this is why the 200 will go here. Everybody okay? So that's where that information go, right? So this information 200 at the end of the previous year is the beginning for the upcoming year. So that's why you put the 200 there. Now, all you have to do, just figure out this number, correct? So then as we said, well, so that has to be 2,000 plus 500 minus 200, right? So that's 2,300. Are we okay? So that's okay. So then you keep adding stuff, okay? So then quarter two, so just keep building up the T-chart. So 6,500. So 6,000 is how many units you sold. 500 is right here. So then you get, okay, the total units you have to produce, right? So then that will be 6,000, right? So you keep, okay, working on this. Now, if I keep writing this, okay, so this is basically, okay, where you get on this. So first of all, the 200, it become clear, right? So the 200, if you use a T-chart, you know the 200 will be the beginning. Now, this is exactly the units sold plus the ending, that's that credit side, and the ending minus the beginning give you the units to produce, right? So if you put a number in 200 plus 2,000 plus 500 minus 200, that's 23, all right? So then which means, okay, what's ending is also beginning, right? Because look at here, what's ending here is the beginning for second quarter, right? So then I will continue to, so when I look at the second quarter, this is the beginning, this is the ending, this is how many units I sell, and this is how many units I'm gonna produce, okay? All right, so this is why you can keep going, right? So putting the number here, right? So 500 was in the ending will become beginning, and so on and so forth, okay? All right, so then you can, okay, do the calculation, okay? All right, so that's not so hard to fill up. So the whole thing is, okay, can you actually produce this worksheet without the table, right? So if people ask you to do budget, you should be able to, this is what you do, right? So give me the units you try to sell, give me the ending, give me the, okay, then I can, okay, basically go from there, right? So that's then you get the units to produce. You should be able to do this without this table, right? So then the way to do that will just be using the T-chart. Now, if I keep working on this, right? So, so I'm gonna, okay, so it's a 6,100 and 1,000. So 6,100, oops, 1,015, 150, right? So then what we try to get, so this is, okay, this is wrong. Oh, this is wrong. Why I'm doing that? Okay. So this is 3, and then you have 1 box and another box, okay? So that's basically what you try to do. Okay, what I'm getting here is, what about annual, right? So if I'm looking at annual, right? So it's the yearly for the entire year, right? So entire year, you're basically looking at, I'm gonna take the 200 as the beginning, correct? And then I'm gonna take the last one for quarter 4 as the end, correct? So that's okay, so that becomes easy to see, but because, okay, when you get to here, right? So this is the sum, total sales, so you're gonna add all this, right? But what I'm gonna do for the ending and beginning, do you add the sum? No, because the T-chart said, what's beginning for the first quarter is the beginning for the year. What's the ending for the last quarter is the ending for the year, okay? So that's why you're gonna put 150 here, which is this number, and you're gonna put the 200 here, which is the, okay, the beginning, okay? So that will make it easy, okay? All right, so then this is of course, is the total sales, okay? So total sales, the 2,000, 6,000, and so on and so forth, okay? All right, so then you get the total, okay, so total units to produce. So that's, okay, how you can see the table structured based on the T-chart. Okay, so the T-chart will help a great deal, okay? Any question? All right, so that's, okay, the number, okay, I gave you. All right, so you can, okay, check numbers. All right, so sometimes the manager, okay, make it easy, so they do not estimate all these, okay, numbers. They will say, well, I'm gonna keep a fixed amount of, okay, any inventory, okay, as, okay, a percentage of the next year's demand, right? So the next period demand or next expected sales, so you can do that. So I didn't do that. Later I'm gonna show you how to do this. All right, so now let's move on. So given we already know how many units, so this is important. So the units we try to produce for the entire year is 14,950. And then also for each quarter, so this information is super important because you are gonna decide how much material, labor, overhead you're gonna consume based on those numbers. So this last row is what we try to plan on production, okay? So we don't plan on production based on this. Notice the difference between those two rows, right? So this is how many units we're gonna sell, but this is how many units we're gonna produce. We consume material labor for this, not for that. That's already done for this, okay? So that's why this will be our, okay, so reference number. Is that clear? All right, so now let's look at, okay, for direct material. For direct material, okay, so of course, if you want to, okay, plan on your operation, and then you always, okay, you never will have all the material you needed, right? So first of all, it's gonna take a lot of space, and then it's gonna take a lot of, okay, manpower to manage. So that's why you always purchase, right? And then, okay, it's subject to inventory management policy, right? So then the way we do this is basically, again, going back to the material T-chart, alright? So then this is the units, okay? So then you will have the beginning units, alright, so ending units, and then that's a purchase, and this is used. Alright, so that is the, okay, so how you do, okay, so the purchase budget is basically the units of material and the purchase cost. So there will be two things coming out, because the manager will care about what's the quantity we have to purchase and how much we have to spend on purchasing the material, right? So those two things. And that's basically what we can get from this budget. And again, this is okay, so purchase will be the material used plus ending minus beginning. All right, so now let's see, okay, how we do this. Okay, assume each unit of product require 26 pounds of raw material. So this is the technology. Okay, it's not estimation, right? So different company will have different, right? So depends on what, do you use pounds, do you use, okay, some other, okay, units, right? So to ounces, or do you use, okay, some different, okay, units for the material. So this is basically all the, okay, technology, production technology. And each pound costs 2 cents. So this is estimation, right? So it depends on the market for the, okay, raw material. So you have the estimation, and then the firm inventory policy is, okay, so it's a 5% of the next period production need, right? So next period, okay, I need this much of direct material. I wanna keep 5% of that as the ending, right? So I will already have 5% set up. Now, this is the management decision, okay? So it's a policy. So now you see the information, right? So you get information all over the place. So that's, okay, all you need. Now let's, okay, construct the, okay, direct material purchase budget, right? So if you already know how to do this, right? So the challenge for you is, without the table, can you actually write down, okay, here are the information we need, here is how the budget look like, right? So that will be a good way to think about those material, all right? So then what we do is, well, so this is what we have, right? So notice, we focus on the units produced, right? So that's from problem 2, right? So from problem 2, you get this number, so that's P2, right? So I'm gonna write P2 as a problem 2, right? So then you get all this information. Now, okay, we're gonna translate this into direct material use by multiply 26, okay? So 2300 times 26, right? So you have to translate into, so those are the units of the final product. But each product requires 26 pounds of material. So that's why you have to multiply by 26 to get all this number. Okay? So that is the basically the first information you need. Now I'm gonna, okay, put this into the T-chart, because that's, okay, that's important to see, okay, how we incorporate the inventory policy. So for direct material, so again, this is a quarterly, okay? Oops. All right, oops. All right, so then we will have, okay, so this is a unit. All right, so in pounds, so I'm gonna write, okay, so this is in pounds, okay? All right, so then we will have, I'm gonna write this information. So this is the information used. That means it's on the credit side. I'm gonna put all this information on the credit side. So 59,800, okay, so that's for the first quarter. 156. Okay. 145, 600. And 27, 300. All right. So then we will have, okay, so this is quarter 1 balance, this is quarter 2 balance, quarter 3, so this is ending, so this is end, right? So make sure you understand this is end, not the, okay, beginning, alright. So now it says, the policy says, the ending inventory, okay, is a 5% of the next period production need. Now, when I get to quarter one, my next quarter production need, I need this much, okay, this pounds of direct material, right? So then my, okay, ending balance will be 5% of that, okay? So that will be 5% of 156,000, okay? Then you do the same thing, okay? So quarter two, then I will look at, okay, so the third quarter is 145, so 145,600, right? So, and then the next one, okay, by the end of the, okay, third quarter, I will look at the fourth quarter, so that will be 27, okay, 300. Now, when I get to 4, naturally I'm gonna look at the following quarter, right? So the following quarter, it says, it's gonna be 2,200 units of production, so that's the estimation, right? So then we will have 5% of 2,200 multiplied by 26. Does that make sense, right? So you have to change that into direct material, right? So it's almost like, well, so it's 2,200 times 26, right? So that's how much I need for the following quarter, and then 5% of that, okay? All right, so now, so this is okay, seems to be okay, everything is in place, right? So all you have to do is try to figure out the box, right? So as what we did before. Now, the only thing missing is the beginning, right? So the beginning, we still have the quarter beginning. Now, the beginning is, remember, is the ending of the current quarter, right? So if I'm using this, remember this is a policy. It's not really, it's a management, okay, decision. It's not really an estimation. So when we get to the end, so I'm gonna write it here. So direct material, so this is December 31st. So that shows, okay, it's in the current. So when I try to get the ending, that will be 5% of the next quarter demand, which is 59,800. Does that make sense? So that will be 5% times 59,800. Now what's ending is also the beginning for the next one. So that's why this one will be 5% times 59,800. Okay, so you can, okay, it's really difficult to understand this if you don't use T-chart. But if you do use T-chart, we systematically follow the same inventory policy. Does that make sense? Right? So, and then that's how you, okay, get this information. Now, going back to this table, right? So the ending of quarter one will be 5% of 156,000. Then you can keep doing this, right? So 5% of 145,600, and so on and so forth. Now, when you get to quarter four, that will be 5% of, so because the next quarter is 22 times 26, okay? So then, okay, so the total will, and then, so this is basically what you get for the beginning. So the first beginning is 5% of 59,800. Now, if you only look at the table, that's confusing, right? Why the beginning is 5% of this, right? And then the rest of the beginning will just be whatever is the ending, right? So you will put a number there. Okay. Now, okay, so, and then, okay, so the direct material purchase, then you just look at here, right? So you look at the direct material, and then so 59,800 plus the, okay, ending minus the beginning. So if I wanna get this number, which turns out to be 64,610. All right, so how do I get the 64,610? So that will be, I didn't calculate, so I'm just using the formula. 5% times 156,000, that's the ending inventory, and minus 5% times 59,800, that's the beginning inventory. Okay, so it's used plus the ending minus the beginning, right? So then you get the, okay, total direct material purchase. Okay. All right, so how do I, okay, so then you can do all this, okay, so for each quarter. Now, how do I calculate the total purchase cost? So that will be multiplied by 0.2, okay? 0.02. Okay, so 0.02, because that's 2 cents per pound, okay? So that's how you get the cost. Now, in terms of, okay, the annual, right? So for annual, for the ending, we already know this number directly going ending, right? So ending will be the quarter 4, right? So then the beginning will be the, okay, beginning of quarter 1. So that will go in here, okay? And then the total direct material purchase, that will be, you can either do sum, or you can use this number plus the ending minus the beginning. Either way works. And then for the total purchase price, then you're gonna also, okay, sum up. Okay? All right, so that is the, okay, the direct material. So direct material, so inventory is always the most complicated one, because you have to, okay, keep track of a lot of things. Okay. Are we okay? So I give you the solution, so you can, okay, check your work. But hopefully you get the, okay, how this works. But in order to understand those numbers, so T-chart will help, right? So that's where I'm going with. All right, so now let's look at, okay, direct labor. So for direct labor, all right, so, and then usually it's based on the hour and then hourly rate. So how do we determine the, so by the way, you have to do the material budget for every type of material, direct labor budget for every type of labor, okay? So you have to be, it's not like all the material all together. You have to look at the material for each one, look at the labor for each one, right? So some people work on the assembly line, some people are engineers, some people, so it's gonna be a lot of, okay, so a lot of worksheet. All right, so direct labor will just be units multiplied by units produced. Oh, one thing, by the way, I forgot to mention, okay, so okay, come back here. So with this information, one thing which is important to know is we can calculate the direct material cost per unit, okay? So that is dollar per pound and times pounds per unit. Make sense, right? So that's the definition, right? So dollar per pound, we know that, that's 0.02. And pounds per unit, we also know that, that's 26. So basically the cost for direct material per unit is 0.52 per unit. So that information will be important. Are we okay? So this is, okay, how you calculate the direct material per unit, okay? All right, now let's look at direct labor. So direct labor, all right, so this is the information we have, very simple. Now you see the information getting, okay, easier and then simpler and simpler, right? So 0.015, this is the technology. Basically, okay, how long does that take to serve your customer? How long does that take, okay, to do certain things, right? So then that's, okay, so that's technology. Hourly rate, this is either regulation, if this is a minimum wage, or this is actually determined by the, okay, so the firm policy, right? So if you are in this position, you get paid, okay, hourly on this, right? So that's already determined. Unless there are some, okay, merit-based, okay, raise and everything, we are not talking about that. We talk about, okay, so the cost for the, okay, workers, okay? All right, so then given this, and then just try to make sure I'm not forgetting. So direct labor per unit, we can calculate that. That will be dollar per hour, all right, times hours per unit, correct? So that's how you calculate the, okay, direct labor dollar per unit. So dollar per hour is 15, and hours, okay, per unit is 0.015. Then you get a 0.225, okay? So per unit. We doing okay? All right, so now let's see, okay, how we are gonna do this. So the table looks, okay, pretty easy because direct labor, I know I require 0.015 multiplied by the units. That's it. right? Because, okay, every unit require 0.015 hours, you just, okay, multiply, then you get that, right? So then for the total, you just sum them up, okay? Now for the cost, that will be 15 times the direct labor hour, right? So that's it, right? So then you will get, okay, whatever number come here, and then you multiply by 15, you get the direct labor cost. Pretty straightforward, okay? And again, so this can be summed, all right? So, or you can multiply by 15, you get the same thing. Right? So that's pretty simple. Now, okay, so overhead. So overhead is even easier because we already doing an estimation, right? So for overhead, the only thing, okay, you have to pay attention is we separate the fixed cost and the variable cost. Fixed cost, we're just gonna give a fixed amount, right? So you know exactly how much you're gonna pay for rent, for insurance, for depreciation. So that's basically, okay, so that's okay, you know exactly, okay, the fixed overhead will be. It can be estimation and very accurate estimation. Now for variable, we already have that. That's the predetermined overhead rate. And then when you calculate the variable, the estimated variable, so this is essentially the second formula. Okay, I wanna see, remember in chapter 4, I said there's only 2 formula, right? So the first formula to get the predetermined overhead rate. The second formula is to get the total, okay, the allocated cost. So that's basically predetermined overhead rate multiplied by the budgeted cost driver. Okay, so that will give you the budgeted, okay, variable overhead. And this is especially you do this for every single product. Okay, so that's the budgeted cost driver for a product multiplied by the overhead rate. Then you get your, okay, so budgeted variable overhead for that product. So that's the second formula I'm talking about. Are we okay? So make a connection, okay, with what we had before. Now, okay, so this is the problem we have. All right, so fixed overhead, so that's an estimation. So you estimate. And variable overhead, that's also an estimation. So and then direct labor hour is the cost driver. Okay, does that make sense? Right, so yeah, that's all you need, okay? So now let's, figure out, so this is okay, so this is wrong. So this should be overhead budget, okay? Okay, by quarter and in total for the year, okay? All right, so now how do we do this? That's simple, right? So every, so it's $10 per direct labor hour, right? So 10 times 34.5, that's it, right? So it's basically $10 multiplied by all the, direct labor. So this information is coming from problem 4, okay? So where do I get the direct labor hour required? So you go back here, right? So problem 4, this is where you get that, right? So this information is coming from problem 4, okay? All right, so that's the problem, okay, P4, look, so this is a problem 4, you get this information, okay? All right, so then you multiply, you get all this, right? So now fixed overhead, I already put a number in, because it's exactly the same. So then overhead total is just a fixed overhead plus variable overhead. So the 2 add together. So then for the entire year, you just do the sum, okay? So that's it. We okay? All right, so that's the solution, okay? So 10 times 34.5, so then plus 45 plus 320, that's 665. All right, now, so we have all this. Now, we are ready to, estimate COGS now, okay? So COGS is based on the fixed finished goods, right? So then we are gonna have, COGM, COGS, and then beginning and ending, all right? So then in order to get COGS, right? So then you're gonna use beginning, okay, so this is wrong, right? So you're gonna use beginning and plus COGM and minus ending, okay? So this is, okay, to notice, but it doesn't matter. We use T-chart, formula doesn't matter, okay? So you don't have to worry about that. Now, expected COGM, so this is what we are dealing with. Now, remember, it's a working process, right? So you have the beginning, you have the ending, right? So then you have material, labor, and the overhead, correct? And then COGM, okay, goes to the credit side, which will go back to finished goods. Now, in the budgeting process, we are not gonna estimate how many units not finished, how many units, okay, not finished from the previous year, how many units not finished in the current year. We're not gonna do that. So we just, okay, assume this will be 0, okay? So there's no point. So we just focus on, this is how many units we're gonna, okay, produce. Okay, 14,950, that's the how many units we're gonna produce. Let's figure out the direct material labor overhead. Then it will become direct, because the beginning ending becomes 0, right? So you wanna make sure the T-chart balanced. So that means the COGM will directly be direct material labor and overhead. So that's the reason, okay? So I don't want you to get confused. Why COGM is the sum of material labor overhead? Because, okay, we don't have, okay, 0. We don't have units for, so we just take the total units we complete. Whether we have, okay, any units, okay, at the beginning or left, it's no matter for us, okay? We don't, okay, worry about that, okay? All right, so now given this, okay, now we can, okay, do the calculation. So here's the information we have, all right? So we have the beginning, so this is the, okay, reality, okay? So this is a reality because you literally can check. And then, so this is assumption, okay, it doesn't matter, okay, we just assume those are 0. All right, so this is an expense, we are gonna keep that, okay, later. All right, so that's how you look like, okay? So all our job is first, okay, do the COGM, okay, so that's the first step. First step is to calculate COGM. COGM is the sum of all this. And then this is for 14,950. Okay, 14,950 is the number we got from problem 2. Okay? So that's the total units produced. I'm gonna, okay, so go back to problem 2. Even we use this number over and over. So that's the number, 14,950. We're gonna, okay, compute how much, okay, material labor overhead we consume for producing 14,950. Okay? So then go back here. All right, so the way to do that is there will be 14,950. What's the cost of this, right? So the cost of 14,950, there are 4 parts. So there's a material part, labor, fixed overhead, and a variable overhead. So there will be 4 parts altogether, all right? So then in order to calculate each part, then we need to calculate the, okay, so basically it's the cost per unit and time 14,950, correct? So that will be the idea, right? So material cost per unit multiplied by labor cost per unit, a variable or fixed overhead per unit and variable overhead per unit and multiplied by 14,950. So that's where you get all this, all right? So now let me explain, okay, the cost per unit, all right? So direct material per unit, we already calculate that, right? So that's a 0.02 times 26, right? That's the, okay, 0.52. Direct labor per unit, we also already calculate that. That is 0.015 times 15, right? So that's a 0.225. All right, so now fixed overhead per unit, all right? So we haven't calculated that, but we know the total fixed overhead. So the total fixed overhead is from problem 5. That's this number, 1280. So 1280 is the total fixed overhead. So 1280 divided by 14,950. Okay, So that's the fixed overhead. Now we also have, have to calculate the variable overhead per unit. So I'm gonna, variable overhead per unit. Okay, so that equals, all right, so information we have is a variable overhead per direct labor hour multiplied by, direct labor hour per unit. Make sense? All right, so you base on the cost driver. So now, variable overhead per direct labor hour, we got that from problem 5, right? So that variable overhead is $10 per direct labor hour, okay? So that's the $10 we are gonna use. So that's 10, okay? And then times the direct labor hour per unit, we got that from 0.015, right? So that will give you 0.15. Okay, so now we go back to, what's the total cost? All right, so I'm just gonna write, so this is a 0.52 times that, this is a 0.225 times this, all right? So then this number, you divide it by 14,950 times 14,950, that's exactly the same number, so 1280. So then this will be 0.15 times 14,950. Now, you have all the information, okay? So let me, write that down. So then you will get, this is basically what you have. 0.52, 0.225, 1280, so that is your fixed, okay? And then this part is your variable, okay? All right, so now you have, 1, 2, 3, 4, 4 items. Adding them together, that will give you COGM. So COGM, so is the sum of this, so that will be this number, okay? All right, so that number, I'm gonna put it, 14,660.25. Now, beginning, we already have that, 195, right? So that information is there, 195. Now, ending, all right? So the ending cause this is a complete unit, then we need to know what is the, how many units we have. So now we go back to problem 2, okay? So this is basically where you're gonna go all over, use all the information. So problem 2, where do I have the ending at Q4? So maybe this is not clear. So ending at Q4, that's 150 units, all right? So all you have to do is the unit cost times the units, you get the ending balance. So that's chapter 6, right? So how do you determine the ending units? Ending balance, that's the ending units times ending. So now ending units is 150. Now I need to calculate, so the unit cost. So the unit cost will be 0.52 and 0.225, all right? And unfortunately, I have a big number here, 14, this, and 0.015, okay? So this is a small number. If I can get that, 0.8, so this is, I'm gonna write it here. So this is 0.0856, all right? So then, if you add that, so that will give you 0.9806. So that is the unit cost. We okay? Everybody follow? Right? So I'm just taking, again, 4 parts. Direct material, labor, fixed overhead, variable overhead. The concept is always the same. When you talk about the cost, you have to have all 3 parts, all 4 parts. Now we have the fixed and the variable overhead. Now with this, then you get, unit cost and, so the units. So 150 times 0.9806. So then you get, 147. So 147.9. Now you just have to do, COGS. So that will be 195 plus 1466.25 minus 147.09. Okay? So that will give you the budgeted COGS. Now for expense, all right? So expense, we have a fixed part. We have 4% of sales as a variable. That's easy, right? So this is the sales, okay, from problem 1. Okay, 4% of that, that's a variable. This is a fix. You get the total budgeted expense. Now you have, okay, sales minus COGS minus operating expense, you get your operating income. So that's the whole operating budget, okay? Success. So that's okay, so this is basically, hopefully you get an idea, right? So I like to have a big problem in one class, right? So that you get some idea like how to do this, right? So then you just have to digest, okay? If I go a little bit faster, you can go back to look at the numbers. Any question? All right, so if there's no question, I will see you next week.